How to use MetaTrader 4. Firstly, let's talk about what investing in foreign exchange means. It does not mean buying foreign currency and keeping it up until it fares well in value. Converting the money you have and holding it till it appreciates in value can take you only so far. Usually you may gain about a few dollars over a period of a year by doing that. Then what does it mean? It means actively trading currency in a foreign currency marketplace or an exchange. Before going into details, let's see how a FX market really works. In FX markets there is no concept of buying a currency. There is always an exchange of currencies, one being bought and the other being sold. Let's take this to a level that we are all comfortable with. You'd usually buy dollars, but what we actually do is exchange the local currency we have into USD at the current market rate. Let's assume the dollar is at 105 local currencies units. Now we'll spend 210 equals and buy $2 and we'll keep the dollars with us. If the dollar rises to 110 equals, our investment has also appreciated. To make use of the appreciation, we have to resell the dollar at 110 equals and we would have made a profit of 10 equals on the transaction. Now look at this from a purely external point of view. Initially the investor gives out some currency to buy another sort. Then when the rate rises he sells what he originally bought and buys back the depreciated currency. The difference in the rate he bought it and sold it is his profit. Well, what you've just read through is all a lie. But it's an important lie to get introduced into dealing in forex markets. To be fair, the above sums up the principle of a forex dealing place. It will help you to understand how the profit and loss taking really happens. But that's not how it operates. We know that with an exchange place we will be trading currency pairs. The rate of the currency pair would typically be expressed in 5 numbers. The smallest change possible for each pair is known as a pip. In most exchanges each lot of the traded currency is in lots of 10,000. Thus if you buy one lot of GBP USD at 1.9825 you are actually buying 10 British pounds. The amount of USD you spent for this is 10,000,19825 equals $19,825 US. Let's say you hold the currency pair till the rate goes up to 1.9830. You will close out the position by selling the GBP and buying the USD. Thus you will sell out 10 British pounds and buy USD. This would yield $19,830 US. The rate of the currency increased by 5 pips and your profit increased by $5. If each lot was 100,000 units of the currency, then for the same 5 pip increase the profit would be $50. For any currency pair that looks like XUSD this is the case. Let's look at the USD JPY pair now. Pair is at 106.38 and you buy it, that is you buy 10 US by spending Japanese yen. Now that's a problem, right? Cause you deposited the money in USD but definitely you don't have any JPY. Not a problem. The exchange knows that what you'll do is opening up a position and later closing it. Thus you'll buy some USD spending the JPY you don't have and buy back the JPY later. So the exchange will settle the net cash amount for you without bothering to look whether you have JPY or not. So let's say you buy the USD JPY pair for 106.38, you buy 10 US spending JPY. If you had JPY, what would be the worth of it? You'd spend 10,000,106.38 JPY to open the position. Now let's say the currency pair rises to 106.48 and you close the position. What you'd technically do is to sell out the 10 US and buy back the JPY. The amount of JPY that you'd receive would be 10,000,106.48. Thus your JPY worth has gone up by 1,000. If you convert this to USD it would be a net gain worth 1,000,106.48 equals $9.39. What the exchange does is to pay out this $9.39 to you. There is no need to convert your dollars to anything or whatever. Everyone is happy. Obviously it's not easy to calculate the gains or losses on a non-USD denominated currency pair. Thus the brokers publish lists of pip costs. It tells you how much of a gain or loss you'd make if the pair moved by 1 pip.